Well, good morning and welcome back to the Broadcast Retirement Network's BRN Sunday podcast. I'm Jeff Stein, your host. I'll be joined today by members of the media, academia, and financial services as we go around the globe to discuss all the issues in retirement markets, technology, personal finance, so much more. We've got another great show for you this week, so sit back and relax and enjoy this episode of the BRN Sunday podcast. We're going to kick things off with a look at technology, and joining me on the line, he's Senior Technology and Consumer Products Reporter with The Motley Fool, Daniel Klein. Hey, Dan, how are you?
Hey, Jeff, at least I was that before the pandemic. Now I'm largely a video host for the Motley Fool.
I know, you're almost like a game show host, because don't you also do like a video? You did a Jeopardy or some type of game show, right?
on Fridays at 11 o'clock on Fool Live, which is our service for members, I do a show called Fool Me Once, which is basically a trivia game where the goal is to teach financial lessons. I actually think it's something that once the pandemic is over, we'll bring out to schools, because it's a really fun way to sort of illustrate points of, some people, there's a lot of things people think, like, cord cutting is 50 million people. Well, that's not true. So getting that information out there is something I'm really proud of doing.
Yeah, it sounds like a lot of fun, and I think people should definitely check that out. I think there's a lot of great content that clearly Motley Fool produces each and every day, writes podcasts, etc. So people should certainly check it out. But I know you want to talk about a lot of different things. A lot going on in tech this week. I know you and I talked on the network about the repositioning of the S&P 500. We also had a conversation with Devin Banerjee on the show and what that means more broadly. But you wanted to talk about maybe Amazon and also retailers. But you go.
Yeah, so let's talk about the coming war over healthcare. Every company, Amazon, Apple, Google, it wouldn't shock me if 7-Eleven had a division working on a healthcare product. We're in a time where there's an overall willingness to look at how we treat health and maybe change that. Now, does that mean health insurance is going to change? Well, that's a political question for the most part. But how we track our health is absolutely changing. I'm holding it up here, even though we're doing a podcast, but I wear a Fitbit. My Fitbit tells me how many steps I've taken. It tells me if I should stand up because I haven't stood up in an hour or two. That's not necessarily useful when you're sitting doing live television for multiple hours. But Amazon has released a device called the Halo. And it looks like sort of a Velcro wristband. But what it does is it monitors so many aspects of your health. It can tell if your temperature changes. Well, that's really valuable in the COVID era. Yeah. It can tell if your stress level has changed. Now, I'm not sure how well that's going to work, but it monitors your voice for signs of stress. Again, as someone who's doing a podcast appearance where I'm maybe a little more hyped up, I'm not sure that's going to be that useful for me. It can monitor your heart rate, which obviously a lot of watches can do. It monitors your sleep. It can go 6 days without a charge, and it's being sold on a subscription basis. You pay more the first few months. I think it's $60 the first few months, and then it's a $3.99 subscription. So it's a really inexpensive way to get some very high-end monitoring. Do I think it's going to be a blockbuster hit? I don't. But do I think it's the beginning of a new era? Yeah, I think it's the next step after the Apple Watch, after the Fitbit.
Yeah, I mean, look, it makes sense, and I know you're talking tongue-in-cheek when you think 7-Eleven's going to get into the business, but I do think, look, that the proof is in. We just been through a pandemic. Everyone is hyper-focused on their health, hopefully washing their hands, staying socially distant. They want to make sure that their vital signs are leading to a healthful outcome. So I can understand where people are going to get really want to get involved in this. Dan, the underlying technology, though, the data, that seems to be the angle where the Googles, the Fitbits, the Amazons, I mean, right, you're going to get a whole collection of data about how people are behaving, and that could be really instructive for future healthcare initiatives.
Yeah, absolutely. So the aggregate data, maybe Apple could say, hey, I've noticed, or Amazon or whoever it is, I've noticed that in southern Florida, these health trends have emerged. People don't take enough steps. They're not sleeping enough. And then you can look at how do you address that? How do you fix those areas? You can take broad steps. Obviously, there is some doubt on a personal level of how much of this data you want to be turning over to any of these big tech companies. But I think they're very aware of that. So they're giving you a lot of promises, but is Amazon going to serve you ads based on some of this information? That's probably going to be an opt-in.
Hmm.
So if hey, look, if my device is telling me I don't sleep enough and they want to give me ads for meditation apps or whatever, that might be beneficial to me. So I think we're in a really early stage of this, but the more we know about our collective health, the more we can do about it. So look, Apple has long talked about this, and on your Apple Watch, they ask you for permission to include you in studies and surveys. And this is going to become a whole branch of healthcare research where you just take this data. Look, we couldn't get pulse rate data or heartbeat data for tens of millions of people. We couldn't do that 2 years ago. Now we could do that easily now. Your Apple Watch can give you an EKG. That's unbelievable.
Dan, how accurate? You mentioned the EKG, you mentioned the pulse. I know that I had it in, I think, version 2 or 3 of the Apple Watch. Maybe it was version 2. And on the rower, it didn't even register the calories burned because I wasn't moving my arm. So how has the technology progressed, and has it progressed enough so that the results, like an EKG, like the pulse, like the stress level, are accurate enough to reflect what you could or should be doing?
So there are still some problems. If I walk on a treadmill with my Fitbit, I have to put it in my pocket so it tracks my steps
Okay.
because it'll get the movement of my leg. It won't get the movement of my arm
Hmm.
holding onto the treadmill. That's a pain, and I actually think they should make it easier to manually input exercise. I know some people will cheat, but who are they cheating? They're cheating themselves. Um, and yeah, there's problems like that on a rower where your arm position stays stationary. On the other hand, they can track things like how long is your heartbeat elevated. That's how Fitbit measures exercise. Now, here's the problem. If I have a really spicy dinner, it measures that as exercise because your heartbeat elevates if you eat really spicy
True.
food,
Okay.
or at least mine does. I
I
don't know
think
if
you're. I
that's
think you're right about that. I think you're
you know
absolutely right about that.
so like I had one day where I'm like, I don't remember exercising 90 minutes, and it's like, no, I did the opposite. I ate hot wings for 90
Oh.
minutes. That not literally for 90 minutes, but you know what I'm saying. So here's the thing: is it perfectly accurate? No. But let's say 99 out of 100 people who get a warning that they're having a problem with their heart turns out to be correct. I think the 100th guy might be a little inconvenienced, but he's going to understand that the 99 people that this helped, that's more worth it. It's like the false positive test. Let's say a baseball. We had I think it was 10 in baseball last week, false positives.
Hmm.
And okay, they delayed a couple of games. Would you rather that happened or we weren't doing testing and didn't have this data? Nothing that you wear in your wrist is going to be perfect, at least in the next few years, but it should give you lots of data. And look, I think some days it's sobering to realize, especially in the lifestyle where I am going to an office and sitting at a desk and preparing, shows all day, how little I'm walking. And that does inform my behavior at night, where maybe I will go up to the gym and put half an hour in on the treadmill, not even running, just getting some steps in so I can, make sure I was doing something that day. I think there's a lot of information. And look, I like when a company like Amazon tackles a problem like this because they're making a device that, while it's not cheap, it's also accessible to just about anyone. So if you have a problem and your doctor says, hey, look, I really need you to monitor your heart rate, well, you have a lot of choices. You could go buy a Fitbit. You could go buy the new Halo.
Hmm.
Sleep tracking is really important. I would say I sleep 4 or 5 hours a night. And whenever I wear my Fitbit, it generally tells me how bad that sleep is. And it's not something I've been able to correct, but it's probably good to know that I'm functioning on not that much sleep most nights. And maybe at some point that's something I need to address.
Yeah. Well, Dan, I think you need a little bit more sleep. That's my suggestion to you. So let's shift gears. This is a big week. We've got the recalibration of the Dow Jones Industrial Average for the first time, a major shakeup in 7 years. A lot of tech and biotech involved there, and I guess you also got some sentiment about how retailers are doing and what the expectations of retailers could be or should be going forward. What can you tell us there?
So you're seeing who the strong players are and you're seeing who the weak players are. Now, obviously, the news has been dominated by bankruptcies. Lord & Taylor is closing all its stores. Well, Lord & Taylor was kind of an out-of-touch business that was also hurt by the pandemic. But some of the companies that have come in strong, Ulta Beauty is one that absolutely shocked me yesterday. Their earnings were way better than expected. I don't have the numbers in front of me. I apologize for that. But this is a company whose stores were closed that sells a product that's not entirely essential. I'm sure a lot of people wanted to replenish their makeup supplies, but their digital sales skyrocketed. And that's partially because they created a tool where you could try out makeup on your computer screen. And I have no idea how well it works. My colleague says it works reasonably well, but they pivoted their business. And this is a company whose management I always liked, but there was some question whether they would be able to take something you like to see in person and make it a digital product. And they answered that with flying colors. Here's another one that did surprisingly, maybe not even surprisingly well. Dollar General. Dollar General is, of course, it's not a dollar store. They're a discount retailer. They sell grocery and convenience store, and they serve neighborhoods. So a Dollar General might serve a 2 square mile radius, and this is just a company that executes really, really well. They know where their customers are, and in a pandemic where people are not necessarily in a financial position to go to the traditional grocery store and supply up for a week, they fill a niche where you can go in and buy a little bit of food for dinner that night, 2 rolls of toilet paper, some paper towels, and their results were absolutely stellar. Same thing at Ollie's Bargain Outlet. These are companies we don't think about that often, but Ollie's knows its customers. They pivoted to have more groceries and staples during this, and they've done really well. Some companies that are struggling that have also made good moves, and I'm getting to a point on this. The Gap sold $130 million worth of masks. Is that sustainable? Not beyond the next, hopefully, few months, but it did show a smart move into something people will need. They also reported sales were up at their Athleta brand, and that makes sense because a lot of us are sitting at home wearing yoga pants, not you and I, but
Well, you don't know that, Dan. You don't know that.
That is possible, but mostly women in the yoga pants. And this just shows that the new management at Gap has been more versatile. Their digital sales were up a stunning amount. So it's a sign of life at a company that's been struggling, trying to figure out how to manage its brick and mortar versus its digital presence. And I think what you're seeing here, and this is my overall point, is that companies that have invested in omnichannel, whether they did it 2 years ago or whether they did it on the fly now, and brick and mortar companies that really know their customers, because Ollie's and Dollar General are not doing digital business. Those two categories, ones like Walmart, Target, Ulta Beauty, that will, however you want to shop, you can shop that way. They are thriving. Companies that really, really have the pulse of their customer, they are doing well. Companies like Lord & Taylor, like JCPenney, that have lost their way with their customer, that don't have that intimate relationship, that aren't super convenient, they're struggling. And look, everyone's going to blame everything on the pandemic, but if a company that sells makeup at a time we're not going to work can thrive, then really there's no excuse for anyone. Now, a company like TJX, which is TJ Maxx and Marshalls, will come back very strong, but they have supply chain and inventory issues, and they're very much an in-person business, and it's difficult when you're managing capacity in stores to have that treasure hunt walking around. So there'll be some good retailers that struggle a little bit, but for the most part, we are seeing that the companies with strong management that are able to operate on the fly have been doing well and will continue to do well. And look, as an investor, that's where I would put my money. If I was going to buy shares of companies, it would be in companies that have shown they can handle a crisis. And boy, has this been a crisis, Jeff.
Yeah, absolutely. Well, Dan, really interesting analysis this week. Really appreciate it. And I'm looking forward to speaking with you on the network on Tuesday. And we're going to talk more about fintech investment deals kind of edging up. And also, I think you brought it up, but also the human touch and why fintech's needed as well. Great to talk with you. Look forward to having you back on the program this coming Tuesday.
I'll see you Tuesday.
Before I have to pull the strap out the cut. Give me the microphone first so I can bust like a bubble. Compton and Long Beach together, now you know you in trouble because they
welcome back. Now time to shift gears, talk a little about the latest social media trends and this week in finance. Joining me on the line, Devin Banerjee. He's senior financial services editor for LinkedIn, and he's also the editor of the This Week in Finance newsletter, which of course you can find on the LinkedIn platform. Devin, thanks so much for joining us this morning.
Absolutely, Jeff. Always good to catch up with you.
Yeah, it's always great to see you, and it's always nice to do double duty with you on the network and then have you come on later in the day on the podcast. Thanks for doing that. So obviously a lot going on. You talked on the network this morning about the Federal Reserve Board decisions. You talked about the enhancement of the IPO opportunities that are there and the recalibration of the Dow Jones indices. Dow Jones Industrial Average. But what's top of mind for you as we close out the week?
Yeah, absolutely, Jeff. All of those are top of mind, and I would certainly encourage people to check out yours and my conversation on the network about them. I'm going to bring up a couple other topics we featured this week because it was just such a busy week. And the first one, Jeff, is actually something you and I have talked about a couple times over time, and that is the definition of accredited investors. So, these are investors who are allowed access to private market investments. Think, private equity funds, hedge funds, venture capital deals, and pre-IPO investments and startups. And actually, this kind of flew under the radar this week, but on Wednesday, commissioners at the SEC voted 3-2 to approve a proposal expanding the definition of accredited investors. So to date, investors have typically been considered accredited, well, not typically, I mean, this is the rule, if they had $1 million in net assets, not counting their primary residence, or at least $200,000 in annual income. And what the SEC did, let me just pull up their letter here, their guidance. They added a couple categories to the definition that permits more people to be considered accredited investors. Mainly, the main takeaway is people with designations, certain professional designations. So people like stockbrokers, for example, have to have passed the Series 7 exam, Series 65 exam, and Series 82. Those three licenses, holders of those licenses can now be considered accredited investors. In addition, employees, so workers who are considered knowledgeable employees of a fund, of an investment fund, are now considered accredited investors. And then there's some other smaller additions. So a little bit of a step forward here in expanding that group of people. Over time, people have said, look, this $1 million in net assets threshold, that could be someone who inherits $1 million. It can be someone who comes into $1 million or more, which does happen, and it says nothing of their knowledge, right, or their that kind of credential that they understand these types of investments. So the SEC is trying to open the door, widen the aperture, and allow people who understand these investments. Now, immediately we saw some interesting statements coming out from other associations that administer professional credentials. For example, the CFA Institute of Chartered Financial Analysts, also CAIA of Chartered Alternative Investment Analysts, which are, if you think about it, I mean, those are people who really understand private market investments. But and then even some people we've seen on the platform saying, hey, what about people who get MBAs? They've studied for several years the worlds of business and the world of investing. So the SEC has not yet considered those, but it actually does say in this guidance that the door is now open to considering more people with these kinds of credentials, designations, professional certifications, et cetera.
And, I think, Devin, we've talked about it both here on the podcast, on the network, about expanding opportunity for people to access the private markets. If you're in a retirement plan, for example, you typically do not have access to private, or you only have access to public markets. And I know, just to let everyone know, we're going to be featuring a discussion on Wednesday with Charlie Nelson of Voya Financial, he's the CEO there, and John Epstein on Dakota about expanding the opportunity. But this is really about aligning, giving people who maybe don't have access to those markets, and ensuring that people have the right information to make these very important investment decisions, which you really need to have important information.
Yeah, absolutely. And critics of this expansion, which there will always be, and some of their points are valid. They say, the private markets can be a bit murky, right? They don't have those same disclosure requirements that public securities and public companies that issue public securities do. And so that's always the concern. But I think, this is my opinion, to be honest, I think this step forward, which is ensuring it's kind of a knowledge requirement here, when that the SEC is trying to get at. And I think that is, kind of, in my opinion, an acceptable expansion because you're thinking of who would understand these types of investments. I mean, knowledgeable employees working on a private fund, but maybe don't have that 1 million in net assets or aren't making that kind of money. They have their sleeves rolled up and their hands, right up in these investments, and so they should understand it.
Yeah.
And also to your point about retirement funds, I mean, the larger story here, stepping back, is we need to watch kind of how this SEC under Jay Clayton right now is approaching these things and get a sense of its kind of philosophy here. So this move this week does follow the move in June that you and I talked about by the Labor Department, which Jay Clayton of the SEC had quite a heavy hand in, which was to say that plan sponsors of 401k plans can responsibly, in the opinion of the Labor Department, allow, as part of a diversified, pool of investments or a diversified fund, can allow access to private market investments in 401ks. So we kind of have to keep track of this over time, add up these little steps to get this sense that there clearly is a philosophy under Jay Clayton and this current, administration of the SEC that widening access is a goal of theirs.
Yeah, look, I could not agree with you more, Devin, that you've got to have the right access to information. You've got to be understanding what you're investing in. We do not want people to get themselves in trouble if you don't understand the liquidity, the fees, what investing in private markets means. I mean, it's not just something you just throw, $1 million in if you're even lucky enough to have it.
Yeah.
You've got to be really judicious in how you allocate your money. But I think just having access to these markets could be a good thing for people, especially when you see like the decline in public markets, number of companies, right? I mean, I think that just broadening access probably will make sense. And you see a lot of the, not to get off on a tangent, but of course we do that on the show sometimes, you see a lot of the pension funds and endowments and foundations, those institutional managers having access, and you see what it can do in a lot of cases with these public pension funds to help support the investment return assumptions, which are sometimes very hard to meet. And I think, it might be opportunistic for everyday Americans to have access to it in some way, shape, or form, maybe as part of a target date fund or something in the future. So I'm excited to hear about it, and of course urge caution and due diligence when you're considering any investment, but especially investments like these.
Yeah, absolutely. Shifting gears a little bit, Jeff, just a couple more items that really stood out on the platform this week. The next one I'll mention is some exclusive data from us looking, as you know, we look at trends in the job market, trends in the workforce. So according to some new data from us out this week, there's been a huge boom during this pandemic period of the past 5 months in volunteering, which is really interesting. So members of ours in the United States, which, we have tens of millions of members on LinkedIn, have been adding more than 110,000 volunteer activities to their profiles each month. That's nearly 2.5 times the rate that we're normally seeing. And so kind of a nice sign that people during this period are thinking about how they can help out, how they can volunteer, and help out their communities and their neighbors. So according to our data, the top 10 volunteering organizations of this year being added to people's profiles: number 1, the American Red Cross, Crisis Text Line, Toastmasters International, Volunteer Income Tax Assistance, and number 5, Big Brothers and Big Sisters of America. You can see the rest of the top 10 there in a new article by my colleague George Anders. And as you know, Jeff, under George's page is where we publish a lot of our exclusive data into the labor market and the workforce. So that was a really interesting conversation we saw this week. Yeah,
he's a number cruncher, that guy. He knows how to really sift through data. But I think really this data, I mean, I love all the data you put out, but this really says a lot to me that how during difficult times over the last 5-6 months, and it's going to continue, right, that people are reaching out, helping others, being part of their communities, seeing a lot of organizations, and some of whom you mentioned, that are kind of repurposing themselves and trying to assist others, whether it's getting PPE, whether it's, supporting families who are going through difficult times, right? And so that shows me, and I know that there were some I saw some different stats not related to LinkedIn that maybe some charitable donations were down, but this, people donating their time and trying to help others, that says a lot to me about American values and values of other people around the world.
Yeah, absolutely. I agree. Last item I'll squeeze in, Jeff, as a lot of people are thinking about, which I don't think we're close to, but a lot of people are thinking about the return to work and physical offices. We featured an interesting conversation with the CEO of GitLab, which is actually the world's biggest all-remote company. So it was a really fascinating set of insights into remote working. And he argues against this sort of hybrid models that you hear a lot of companies talking about, where, we can let some employees be fully remote and some employees be fully on-site. He says that given the choice of working from home or in the office, people will feel the pressure to come to the office, out of fear of missing out on information, on access to management, on career opportunities. And so what he's kind of saying is you need to kind of pick a lane and go more fully into one or the other. He says for those companies that are going to consider a hybrid workforce, which of course many I think will, he has some recommendations. He says you can try making sure everyone works 1 day a week remotely so that, those who are typically going into the office can empathize and understand those who are working at home. And then, a big one, which it sounds trivial, but I think it is a big deal in terms of meetings, which people fear they're going to miss out on meetings and that in-person access. He encourages meetings that are occurring in the office to have the people dialing in from that meeting in the office, to have them dial in from like separate pods. Or actually, I featured an interview with the vice chairman of Hamilton Lane, a big private market investment firm, a couple of weeks ago, and he said they may have people in the office dialing in from different iPads, so that everyone is still one face on the screen, and there isn't a side conversation happening in the conference room that the remote employees are not a part of. So again, all these things sound trivial, but we're basically been forced to figure out what the future of work is going to look like very quickly. And so taking these insights from, again, the CEO of GitLab, the world's biggest all-remote company, could certainly be useful.
Yeah, really interesting, Devin. I like the part about dialing in from separate iPads, even if you're in the office, because one of the things about being in a face-to-face meeting in a conference room is you can do, hey, look at this, and then you write something on a pad, and you can, and you can pass notes and things like that, and you really can't do that virtually, and some might be at a disadvantage. And I would just say, broadly speaking, I think there's some lessons to be learned. You mentioned this hybrid model. You look at what's going on with schooling, right? We're going to feature somebody. We featured Mari Backman talking about not personal finance, which she normally covers on the network, but she covered the decision to send her children back to school. And a lot of school districts are suggesting different thoughts about hybrid or putting people in classrooms, and it's forcing parents to make decisions. So I think a lot of this is going to be thought through and decided upon over the course of the next 6 to 12 months as we kind of hopefully return to the office and shed this coronavirus.
I agree, but for now we're in this new normal, and we've all got to figure it out.
Absolutely. Well, Devin, always a pleasure chatting with you. Really interesting stuff, and I always appreciate you doing double duty, and I appreciate the This Week in Finance newsletter, which urge people to sign up for because it's really great and breaks it all down, breaks down the week's news in one spot. Devin, great talking with you. Look forward to having you back on next week.
Thanks, Jeff. Take care.
Welcome back. Now time to talk markets. Joining me on the line live from the network studio, it's Oliver Rennick, lead anchor for the TD Ameritrade Network. Oliver, how are you?
Hey, Jeff. I'm doing well. Recapping a busy week and a pretty exciting one with new records in the stock market.
Yeah, I was going to say, I wanted to ask you, let's just kick it off because I know your time is extremely limited, but it looks, when you look at the Dow Jones Industrial Average, today's market session we're talking about on Friday afternoon, it's about 1:30 Eastern time, we are back to where we were before the coronavirus struck. I mean, what do we take from all this economic news this week with the Fed, with what's happening today in trading? Give us your take.
So we had a pretty interesting 5 days that, as you point out, did make new highs. We've come all the way back and plus some. after the, not really after, but just in the process of recovering from the virus and the pandemic and the quarantine driven economic collapse. So it was pretty interesting. This week we had a lot of action. We had Jay Powell as kind of the headliner on Thursday discussing a new policy to keep the market and keep the market happy, keep economists kind of happy / maybe, in a little bit of uncertainty in terms of like what the future is going to bring. Basically, they're no longer committing to make moves and interest rate decisions based on purely inflation metrics. They want to be more flexible based on employment. They want to let the inflation rate move around a little bit since they did not have a lot of success hitting 2%. So that's mostly what people expected they were going to say, but there was also kind of some kind of whisper building that maybe there would be something even more concrete in terms of additional commitment from the Fed. So in essence, even though the upper bound for inflation has been kind of removed for the moment, we still have this issue where the lower bound for rates doesn't seem to be changing. It seems to indeed be at zero. He's not going to go negative, and there's nothing really else new coming. So that puts an interesting aspect into the market, which is whether or not bonds are going to move based on inflation expectations, if bonds were moving based on interest rate expectations. And now we're in this environment where maybe the bond market and the rest of the market will move based on the economy instead of the bank, instead of the central bank. So to some degree, that's kind of symbolic in that by instituting this new policy, it seems like the Fed can be at rest for some period until the economy does meaningfully change. So that was kind of the headline.
Yeah.
But in the background, we had developments from Abbott on testing for the virus. We had Moderna continue to make progress on actually elderly patients who were taking their vaccine and generated antibodies. So on the week, actually, the leaders were companies like the Gap, Delta Airlines, Carnival, Live Nation, a lot of reopening trades that did really well this week.
Yeah, and I got to think that, you only had yesterday, Thursday was the announcement from the Federal Reserve Board. So you only have had one kind of conversation session on your show, Morning Trade Live. What was the general reaction from your guests on all the news this week? Was it still mixed? Is it still kind of across the board, bulls, bears, or is there some level of consensus?
Sentiment is pretty high again. Positioning has started to get more bullish. One of the things we consistently highlighted throughout the spring and early summer was that there was a large buildup of cash and a large positioning that was still outside of stocks. That's definitely changed a little bit here, and most of our metrics for gauging sentiment are definitely high. In terms of positioning, one could argue there's still a little bit of maybe ammunition kind of left from investors who are parked in bonds, parked in gold. So it's an interesting idea if those continue to slip, whether or not that money will find its way into stocks. So this week we also saw just a slowdown in some of the other momentum plays, like gold. It kind of didn't really go anywhere until Friday. We saw bonds just kind of bouncing around back and forth. So for the most part, there were some important trades that have been really big winners that have stalled out a little bit. Really, it's just the stock market now that is really running away with it, in particular the NASDAQ, and not a lot of real worries that, the reopening and recovery is going to hurt any of these big tech names and quarantine trades. All those trades are still doing fine. So it seems like the market can rally some of the reopening trades while still adding money into the quarantine one. So it's pretty much firing on all cylinders.
Yeah, it looks that way, and I guess we will know how things progress after Labor Day. And I'll just remind everyone that what the Grateful Dead said in the song Uncle John's Band: "When life looks like Easy Street, there is danger at your door." So it's at your door, so you need to be vigilant. Oliver Rennick, always, yeah, you like that? I brought in the Grateful Dead, my favorite band. Oliver, always a pleasure chatting with you. Great watching you, as always, on the TD Ameritrade Network. People should certainly check them out. Morning Trade Live, and also Markets on the Close. Ollie, take care. Have a great weekend.
Appreciate it, Jeff. Thanks.
Bye.
Give me the microphone first so I can bust like a bubble. Compton and Long Beach together, now you know you in trouble.
Well, we're going to end the show as we always do with a visit by the Legal Eagles. They are retirement rock stars. Joining me on the line, David Levine and Kevin Walsh, both are principals with Penn Law Group, an employee benefits law firm based in Washington, D.C. Gentlemen, how are you today?
We are great, Jeff. Happy end of summer. And as we know well, it's been a busy summer, so we got more to talk about today.
Yeah, absolutely. Well, thanks, David. And Kevin, I'm going to start off with you. ESG, we talked about it a few weeks ago, but it still remains in the news for a lot of reasons. I want to come to you and David for your analysis of recent events that have transpired.
Yeah, thanks, Jeff. And, it's always good being on. And ESG investing it stays in the news, it remains in the news, and we see a lot of the discussions both related to retirement and outside the retirement world. Just as a refresher for folks who may have missed our segment on ESG a couple weeks ago, ESG investing is the idea that you can take environmental, social, and governance factors into account when making investment decisions, as opposed to looking just short-term profits and losses, short-term investment risks and rewards. Long-term investment risks and returns. There's an idea that you want to take into account kind of the ills and goods that may or may not be purely economic that can result from considering these other criteria. So examples of environmental considerations would be taking into account the risk of global warming or taking into account kind of the risks that a company you're investing in could be more heavily regulated if it's contributing to global warming. An example of like a social criteria would be, is your company, is the company you're considering investing in, are they promoting diversity and inclusion? So taking that factor into account. And then G, governance, and this is one that it seems like it's an easier fit for traditional investors who've been looking at profits and losses exclusively. But governance is, how is your company governed? Are there constraints on, board action, CEO comp? Do shareholders have a say? So in recent years, there's been a lot of talk about impact investing, ESG investing. I'm forgetting other terms for it, but the idea here is that instead of just trying to get a return with your dollars, using your dollars for social good. And how this relates to the retirement space is there's been some momentum, primarily in the governmental side, to take these factors into account. Mm-hmm. The Department of Labor has recently put out a proposed rule that's not particularly favorable to ESG investing. And basically the message from DOL is that, retirement plans are already trying to do a social good with all of their investing. The social good they're trying to do is maximize the likelihood that participants and beneficiaries are able to afford a dignified retirement. So DOL's message has been, we really don't want you trying to do other social goods because if we don't maximize the dollars, we might not meet our primary social good here. That being said, there's been a fair amount of pushback on this proposal where investors have said, it seems a little bit short-sighted to say you can't take ESG factors into account. Simply because they might not seem pecuniary today. Because if we do have global warming, if the regulatory environment does change, then those ESG factors could be seen more as an insurance policy that pays off when there's a shift, as opposed to just taking, different people's idea of good into account. David, do you want to chime in, or do you want me to pivot to what the SEC said yesterday?
I was going to chime in a little bit, Kevin. I think as it relates to this, I think you hit the key thing here, that part of what's been going on here, and there's a wide range of views, is ESG, the line between where ESG becomes about, I'll call it good, and when it's an economic factor, is incredibly gray. And there's lots of schools of thought. There are some who say ESG never should have a role because it's not really economic. But there's others, and it's been a louder chorus in recent years than it certainly was 10 years ago, and it's common in Europe and other places, who say, well, ESG it's about social, but you know what? Underneath it all, there's an economic impact. The classic scenario I've heard is we do ESG investing because we think about environmental and say, wait, if we're going to buy properties sitting on the coast where the water is rising, And we're a long-term investor, is it going to be worth it? We can go through the back and forths of, is that valid, is that not, what long-term, short-term, and there's no right answer here. But at the same time, that's the underlying tension. Where does economic end, and where does something beyond economics really come into play? But Kevin, I know you really want to talk about what went on at the SEC yesterday, so I'm going to hand it back to you to just do a little wrap up on that.
Yeah, so I'll do a quick wrap up and just building on what David said. I mean, if you were in the 1980s and you were an investor and you were thinking about investing in a tobacco company, you might look at the decision not to invest as one kind of focus on social factors. You could look at it as one focus on economic factors. On the other hand, when you see changes in the regulatory environment in the future because of those things, you can see how a factor could shift from looking non-pecuniary to suddenly being very pecuniary. Yesterday, the SEC had an open hearing where they were, revising their rules on the disclosure of human capital. Commissioners Lee and Crenshaw, who are the two Democratic commissioners on the panel, so there's 5 commissioners, 2 from each party, and then the chairman or chairperson, which is typically the same party as the White House. But the 2 Democratic commissioners yesterday dissented from a rule that was finalized. And what they highlighted is that there's a need for more ESG disclosure coming from big businesses, coming from reporting corporations. So on the one hand, you're seeing kind of a Republican-led Department of Labor, which is kind of discouraging ESG. On the other hand, we're seeing kind of Democrat policymakers encouraging greater use of ESG. So, depending on the outcome of the election, we could be having a very different conversation next year.
So I mean, there obviously, I think we would expect this conversation to continue. There's a huge trend here that people are, beyond retirement plans, are investing in sustainable and ESG investing. And it just sounds like from what your gentlemen are saying that, this will lead up to the election, and then post-election, depending on what happens, if we have a new Department of Labor, a new administration, that could really indicate a sea change potentially in regulation around ESG, but probably in some other places as well, I would imagine.
You're right, Jeff. And one comment on that is ESG has been a yo-yo since the Clinton administration days between Democrat and Republicans. And there's some commonalities, but it goes back and forth. What makes now a little different, though, is the proposed guidance is not just sort of the interpretive guidance, more regulatory in nature. So, as you know, once you make a formal regulation, it's harder to change it. Mm-hmm. So this might actually, depending on the timing, when and if it gets finalized, challenges, all those things, sort of stop the yo-yo or minimize the yo-yo a bit. We'll have to see. But you're right, with the Biden administration, if there is one, they could certainly have a whole different agenda. And the issue will be, and something Kevin and I have talked about in the past, the Congressional Review Act. Mm-hmm. Will Congress decide they want to step in and claw back a whole bunch of what has been done by the Trump administration at this point? That is, if there isn't still a second Trump administration. David,
I think we should save some of this for next week when we can get into a little bit of what the Biden administration would mean, and then we can pivot into a couple of weeks where we walk through, what the impact of the November election is. I think Jeff and you have teed that up pretty well.
Yeah, I agree. Thanks for cutting me off, Kevin. We're good.
Okay, guys. Well, look, this was great. Thank you so much for stopping by the show. Really appreciate it. Have a wonderful weekend, and we'll talk to you again next week.
Thanks so much.
Bye, guys.
Bye.
Well, that wraps up this episode of the BRN Sunday podcast. I want to thank all of our great contributors and, of course, you, our audience, for stopping by. Don't forget, we're back again tomorrow morning on BRN AM. I'll be joined by the Motley Fool's Deidre Woolard. We'll be talking about commercial real estate and the impact of the pandemic on real estate investment. You're not going to want to miss that. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.